Hey everybody, it's Bruce here with Traveling with Bruce. What do you think of this picture? I love these pictures from the stock exchange floors and the commodity trading floors. The old days where you used to have all the traders screaming at each other and yelling at their desk traders on their phones. Oh, I love it. Some guys give you the thumbs up. I'm having a great time. The other guys, not so much. Oh, man. Thank you for joining me today. It's Bruce here with Stock Markets with Bruce, my new channel. Hope you're enjoying these videos. I want to talk to you today about what happened in the market. June the 15th, 2020. It's Monday. We're back, baby. Look at this happy guy. Oh, man, I miss these. Things have changed. On the old stock market, it used to be that you had floor traders and you had runners, and then you had back at the office desk traders and stockbrokers, and the phones were ringing all the time. And depending on how hot the market got, the screaming got louder in the office and on the floors. And I tell you right now, at the end of the day, everybody was worn out, and the guys would go home and sleep like a log. Because you're so tired, but you're used to this stress too. It's not like that anymore. Things have changed. We do it all from the comfort of our homes, and we do our own trading. We don't even use these guys anymore. It's all done on computer. Things have completely changed out. Today, the market had a 1,000 point move. Unbelievable. Opened low, came up high, and then kind of settled out with a little bit of a gain. Not too much, but it was entertaining to say the least today. The folks, a lot of you folks who were at home, trading at home, they were talking about you today. The talking heads were starting to talk about the new kids in town, the folks who are trading through Robinhood and using other trading platforms to do zero commission trades, fractional trades. You're being called inexperienced day traders, gamblers. They're not really giving you a very high, very high regard, which I think is kind of unfortunate because there are, I think, tens of millions of new investors that have kind of joined into the stock market in the last 3-4 months. And I don't know if the old school guys fully appreciate just what kind of a force the new traders really are. I think today's new stock market players are a different breed, different group than from the gang that you see here. Nowadays, people are putting in $25 a week, $50 a week, $100 a week, $1,000 a month into their trading accounts and beginning to trade them. Some are, of course, speculative, looking for action. Others are long-termers. Speaking of a long-termer, here's one right here. Leo Cooperman. He was the guest today on CNBC's Halftime Report, and he was talking to the gang about what he sees going on. And he was talking about three particular, things that you need to know about the market. He talked about the FANG stocks, which you see right here: Facebook, Amazon, Netflix, Microsoft, Google, Apple. He was talking about these shares, how they dominate the stock market and dominate trading. He was talking about how Robinhood traders who are speculating in stocks like Hertz and American Airlines might be in for a world of hurt in the long run if they're not careful. He's not too keen on seeing a bunch of people starting to day trade like that. And then he was talking about what he does, and which he calls himself a value investor. He believes in buying stocks that are undervalued. In other words, the price of the shares on the open market is the stock's trading at a lower price than the company is worth if you sold everything. And value investors are dividend hunters. They're long-term players. They're very conservative. They pick up their stocks, sit on it, and enjoy the upside as the street figures out, oh my gosh, the stock is undervalued. Here's the Dow today. Look at this opening. It opened down. That little white line there is the break-even line, and it finally happened just around 1, 2 in the afternoon Eastern time, and then went up a little bit, a couple hundred points. I think the Dow was almost up 300 at one point in time today. And it looks like it was up just around 100 or so. It did have a gain after all said and done. I did notice Royal Caribbean was down $6 a share, ended up almost even on the day. A lot of the other stocks were off badly to start, but they all came around. Even American Airlines only lost 3 cents when it was all said and done. A most interesting deal. Another thing Mr. Cooperman talked about was he would like to see the elimination of or the reinstatement, I should say, of the Uptick Rule. You know what that is, you guys? Today, if you feel a stock is overvalued, even for an hour you think a stock is going to go down, you can sell a stock you don't have by shorting it if you have a margin account with your stockbroker. So you sell shares that you don't own, say 10 shares, 100 shares, whatever the price of the stock is. And when the shares do drop in value, you buy them back. And the difference between what you sold them for and what you bought them for is your profit. It used to be in the old days when I was a broker, you couldn't sell stock short unless the sale you made was on what is known as an uptick trade. Now, what does that mean? If a stock was trading at, say, $10.25 a share, and you think it's going to go down from there, and the next trade was $10.20, you couldn't be the person making that trade to go short. You could only go short at a price higher than $10.25 a share. In other words, the next trade had to be $10.26, $27, $28, $29. And when I first started in the market, shares didn't trade in pennies. They traded in 1/8 of a dollar. So they would be 10 to 10 and a quarter would be the price of the stock. You'd put a sell order in there at 10 and an eighth for, say, 100 shares, and they'd have to trade at $10.12.5 for you to get out on an uptick. It's the only way you could sell stock. And if someone only bought 200 from you and you want to sell 1,000 of them, you only got 200 off. And if the next trade was $10, you had to wait at 10 and eighth to get off another bunch of stock if someone came up to get it. If the stock went down to 950 because you were right, the market was going down, you only had 200 short. You could only buy back 200 to cover whenever you wanted to, and you weren't going to make as much money. Now, you don't need an uptick. You can sell it at the market. So as the stock is falling, you can keep hammering the bids on the way down. And believe me, there are professional trading firms out there with billions of dollars of power who will target a stock, and they will assume and amass a short position, gigantic, by sitting around a certain level and just hitting every bid that shows up as the day wears on. It's all computerized, it's all automatic, and it's all invisible to the human eye because no human being does these trades anymore. It's all done by machine. It's not uncommon for day trading firms to short stock, say at $255 a share. They'll short tens of thousands of them, and they'll buy them back for 20 to 30 cents less. They'll only take a 10, 20, 30 cent profit on these short trades. But if you can flip 100,000 shares a day, if you're making $1, you're making 100,000 a day in profit. If you're making a dime per trade, you're making 10,000 a day in profit. It's a question of what your risk tolerance is and what kind of action you want. Now, there are traders who do the other side. They'll buy stock for $250 and sell it for $250.10. They'll make a dime on the other side. Remember, no commissions in, no commissions out, and whatever you net out, you net out. It's quite the business, all automated, all pre-programmed. There are literally software programs that these trading firms have created that do these trades for them, while you and I just try to buy and sell stock like regular traders. 100 here, 20 here, a quarter of a share there, whatever it might be. Someone asked me earlier on one of my earlier videos, Bruce, how do companies like Robinhood make money when they're offering investors the ability to buy and sell stock in $1 investment increments and up? How do these companies make money? Well, they make it several ways. One of the ways they make the dough is they will charge you a monthly fee for what's called their, well, I'll just use the term premium account. Their base account, which lets you buy and sell stock, is free to use, no commissions. But if you want, say, some margin where you can borrow money from the broker, you might have to pay a $6 a month fee to have a premium account, which will give you other bells and whistles, even including some research. And speaking of research, the firms are now offering stock research, technical analysis, and you pay a monthly fee for that service. Now, it doesn't sound like much if you're getting $5 a customer, but if you're getting $5 a customer and it's all online and you have 1 million customers in your firm, you're bringing in $5 million a month in research to tell them how to buy and trade, how to buy and sell. You make money when they buy and sell as well, of course, because you're buying stocks in block trades and you're offering shares in fractional amounts. The other way they make money, they lend you money. So you play the market on margin. So, for example, if you have a firm like Robinhood that has 13 million customers, 8 million of them might have margin accounts. And if you have a margin account, you're allowed to short stock, go long, borrow against the share's value to buy more stock or sell more stock. The amount of money or amount of interest that Robinhood pays to borrow money for you to do that, they will pay a much lower price than you would pay if you were to borrow it yourself. So I can see where Robinhood will borrow money at, say, 1.5% overnight, and they will charge you 4.5% overnight or 3.5%. They will still offer you a very low rate, but they will double their money on the cost of the cash itself. That's another way that the major brokerage firms make an awful lot of money doing this. All kinds of ways for brokers to make money. The bottom line is get your cash into their firms. If they're sitting on your cash, they have leverage to do more business. And the more active you are as a trader, the more opportunity they have to make money on the other side of the trade. Whether they're shorting you stock in-house, whether they're selling you stock from their inventory that they bought at a lower price, but they're looking after you at market, and sometimes they're ahead of the market, sometimes they're not. They can make money all kinds of ways. Anyway, there you go. There's the day today. Another day in the stock market. The Dow had a 1,000 point swing from its low to its high, and there was all kinds of action today. Leo Cooperman said some very interesting things today, and those of you out there who are day trading through these trading platforms, you are being noticed by the old school guys, and they, I think, are underestimating how powerful you are. I don't think they yet know and fully realize how deep your pockets are and what kind of a force you're probably going to be going forward. But I'll stay on top of it, keep you posted. Thanks for watching and joining me today. Please subscribe. Give me a thumbs up if you like what I'm doing. I appreciate you being here. Talk to you later, everybody. Bye for now.